What is going on, everybody, and welcome to boot camp. I don't know what day it is. This is my third or fourth video that I've recorded today for this boot camp. I am going to the beach, so I'm getting all of these out of the way. That way I can enjoy myself at the beach this weekend. You guys cannot say that I am not committed to this boot camp, because let me tell you, recording 3 or 4 videos in a single day and then editing them sucks. Today we are going to be discussing fair value gaps. I'm going to be showing you guys how to identify them, and then tomorrow we're going to be discussing fair value gaps part 2, and I'm going to be showing you how to trade them, and I'm going to be bringing on a special guest who's also going to be showing you how he also trades these fair value gaps. So before we hop into this, as always, make sure you guys are doing your daily check-in. Comment down below letting me know you're still rocking with me and that you're dedicated to make it the entire way through this boot camp for the whole 31 days. Also, while you're at it, make sure to smash that like button as well as clicking that subscribe and that bell icon so you are notified every single time I upload a brand new video. But without further ado, let's hop into the video. Alrighty, so what I have pulled up is the ES futures on the 5-minute time frame. The one thing that I do want to point out about these fair value gaps, and I'll show you guys, is you can identify these on multiple different time frames. It really just depends on what time frame you want to use. So I find a lot on the 5-minute, but you can also use them on a 1 minute, a 15-minute, an hour, a 4-hour, a daily, a weekly. Like literally they are everywhere. So let's start off with what is a fair value gap. Pretty much what this is, or actually what this is a 3-bar setup. So what we are looking for is the first candle, right? Let's just say it's a green candle and we have a little upper wick right here. And then we have a nice lower wick right here. So this is the first candle, right? The second candle, we want to see a large move away from that first candle. So a pretty large green candle in this scenario, right? We want to see that large aggressive move away. And then on the third candle, what we want to see is it could be, again, a green candle. It could be a red candle. It doesn't really matter on this one or this one. The main thing we want to pay attention to is this large green candlestick right here if we're looking for an upside fair value gap. But as long as this wick right here on this third candle does not intersect with this wick right here, a fair value gap can be drawn. And as long as this body does not intersect with this wick right here, a fair value gap can be drawn. Now, what this is implying is that price made a really strong aggressive move away from this level without finding any acceptance in between with sellers, right? So if it's just a strong green candle like we see right here, there was no price acceptance with sellers. There was basically no sell orders inside of this candlestick right here. It's a bullish engulfing candlestick, right? So there was no acceptance down here, meaning price is likely going to come back down and look for some kind of acceptance from both sides. So what we can do is draw this fair value gap. What you're going to do is you're going to take the high of this first candlestick wick and you are going to connect it up to the low of the third candlestick wick. So this would be considered your fair value gap. What we would be looking for from there is for price to come down into this area, start setting up some bullish price action, start coming back out, and then we can look for an upside move. So that's what an upside fair value gap is going to look like. Now we also have downside fair value gaps. So from there, what we're looking for, again, it could be a green candle to start off, or it could be a red candle to start off. The main thing that we want to pay attention to, though, is this second candle. We want to look for a strong, aggressive move away from that first candlestick, right? So as we start getting that, and then we get the third candlestick, again, this could be green, it could be red. So let's just go ahead and let's make this one a green, just for this scenario, right? We have this red candlestick right here. Again, it could be green, doesn't really matter. And then we have this red, strong, aggressive move away, right? The main thing that we want to look for is make sure that this upper wick does not intersect with this candle's lower wick, right? So if this wick were to come up and start hitting up here, then there's no longer a fair value gap there. There was no price acceptance in this area right here as far as buyers. This is a bearish engulfing candlestick. So more than likely, price is going to try to retest this area and look for acceptance from both sides. So what we're going to look for, or actually from there, what we can do is take the low of this first candlestick right here to the high of this third candlestick right here. And what we're going to be looking for from there is for price to trade up into this area, start forming some bearish price action, and then look for a move to the downside. right? So there's multiple different ways that we can find retracements in the market. This is just one of the ways that I like to use. Now, I personally don't only base trades off of fair value gaps. I like to look for other confirmations, VWAP, moving averages, Fibonacci retracements, previous support and resistance, supply and demand, etc., right? So if we have multiple confluences inside of this fair value gap, that then adds even more confirmation to the trade. Now, if we were to enter in this scenario right here, say we got long right at 45.50, our stop loss on this trade would be if the S&P futures fell below the fair value gap. So all I had to do was start breaking below here and you're immediately out of the trade. If you were to go short over here at, let's just say 45.58, your stop loss was if price started to break above this fair value gap. So your stop would have been right up here, and as a result, giving you a low risk entry. So again, this is just showing us where price could potentially retrace to. Now, what we want to do is look for multiple confirmations at that level. So looking at this example right here, there's actually two fair value gaps that you could have drawn. One was right here, right? So as you can see, we have this nice upper wick, nice little strong aggressive move away, and then we have this strong aggressive move away. So we got a little fair value gap there, and then we also have another one right here. So we have two fair value gaps in this scenario. As you can see, price ends up pulling down into these areas. Again, it's showing us where can price retrace to. So if you were to get long on this candlestick, your stop loss would actually be below this low. Again, two fair value gaps in that scenario that you could watch. So that was just one example to the upside. Let's take a look at another example right here. Here's one to the upside as well. We have this nice upper wick, strong aggressive move away. Third candle's wick does not come anywhere close to that first candle's wick. So what are we going to do? We're going to draw our fair value gap. A little larger of a zone than I would prefer, but I know that we had moving averages down at this level. Let me just pop them up for you guys real quick. We had the 8 EMA and 21 EMA both at that area. Again, adding confluence. But as we can see, price retreats into that fair value gap, saw a nice little bullish reaction, and then they continue to push price higher. What about this one right here? There's another one. Look at this upper wick, strong aggressive move away. The bottom of this candle doesn't come anywhere close to this one. What can we do? Look for a fair value gap, and as we see, price traded into this one, push back up into high of day. What about over here? As we see, price made a strong aggressive move to the downside, and then ended up having a nice pump to the upside. We have a nice fair value gap, taking that high to this low. Price came down, wicked off of it here, wicked off of it here, and then pushed to the upside. What about right here? There is a bearish fair value gap. So as we see, taking this low, a strong aggressive move to the downside, and then this third candle's wick was nowhere near this first candle's wick, right? So what can we do? Fair value gap. And as we see, price trades into the area, ultimately rejects it, and makes a strong move to the downside. Let's see if there's any other scenarios. Here's another one right here that you could have identified. This one was to the upside, right? So nice little fair value gap, price dipped into it, saw a nice little push to the upside, nothing crazy, and then ultimately fell apart from there. So here's one right here. This was a very quick one. But anyways, we have this low point right here, strong aggressive move down, price trades back into the fair value gap, rejects the very top, makes a quick little new low a day before pushing back to the upside. Now, obviously, when you are identifying these fair value gaps, you want to be trading with the trend, right? If the trend is clearly up, we're not going to be looking for price to come up and start rejecting off of 5-minute fair value gaps, right? We're looking for retracements in a 5-minute fair value gaps to then look to get long. So that's one thing to keep in mind when you are trading with fair value gaps. Trade with the trend. Don't just trade against the trend just because you see a fair value gap going the opposite way. If anything, you can use other fair value gaps for price targets, right? So if you were to get long and then you ended up seeing, oh, there's a fair value gap right here, you could use that fair value gap as a potential price target, right? So say you started getting long down here and price is moving to the upside, you could say, oh, well, let me aim for this fair value gap as a potential price target, right? But we always want to trade with the trend. You don't want to trade against the trend because that is when you are going to make a lot of mistakes in the market. There was a really wide fair value gap right there. But I'm sure you guys see the point by now on this 5-minute time frame. Let's try a 2-minute time frame, right? I want to show you guys that these literally form on so many different time frames. It's your job as a trader just to identify the setup. So let's see if we can find a good 2-minute one. Okay, here's one right here on the 2-minute time frame. You know, we have this little right here, nice little gap down. We actually had a bunch of them. So let's just take this one right here. It's right there. That's a 2-minute fair value gap, right? let's head on over here. Here's a 2-minute fair value gap to the upside. They are literally everywhere on multiple different time frames. It just depends on what time frame you identify the setup. If you're going to be using 2-minute fair value gaps, I wouldn't be using them unless you actually have reason to believe price is going to bounce or reject at an area. So those are going to be more so for sniper entries, but already at a level of interest. But the higher the time frame that these fair value gaps occur, the more important they're going to be. Even over here was one to the upside. You can see nice little fair value gap. Let's take this and then boom, there's our fair value gap. Price retraces into it, makes a tiny little move to the upside. But again, they're literally everywhere. We can take one more look at the 15-minute time frame and then we'll wrap up the video. But let's just pull up the 15-minute right here. Let's see if we can find any good ones. So there's one right here actually, and as you can see, price ended up breaking above it, and then it went and set another one right there. So they're just literally everywhere. The main thing you want to keep in mind though, and I'm going to keep repeating it, trade with the trend. Just because, you know, price is coming down to an area, but let's just say that the trend is to the downside, you don't want to just go long because you see a bullish fair value gap. You want to go long with other reasoning behind it, like a super strong support level or a super strong Fibonacci or a super strong demand, whatever it may be. And then you can use the fair value gap to help you identify or give you more confluence at that area of interest. But here's one on the 15-minute, right? So we have this nice little lower wick right there, strong aggressive move away. This could have been a fair value gap. There was one right here on the 15-minute time frame. So if we just go ahead and take that high up to this low point right here, you can see price retrace right into it and then gave a nice move to the upside. So high to low, price retraced into it, gave a nice reaction to the upside, and then price continued for the remainder of the day. But that is going to wrap up fair value gaps part number 1. I just wanted to discuss how you can identify these and what they even mean. So tonight I got some homework for you guys. Go back on a 5-minute time frame and start looking for some of these fair value gaps. Just take 15-30 minutes to start identifying them. Again, it's going to be that repetition that helps you identify it in real time in the market. So definitely make sure you guys are doing your homework. And as always, if you did find value in this video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. And I will see you guys in tomorrow's video for fair value gaps part number 2 with a special guest. Everybody have an amazing night, and I'll see you guys then.